Hi, welcome everyone. Good morning or good afternoon, wherever you are located. Thank you for joining us for today's webinar on selling your business. Before we begin our presentation, I have a few housekeeping items to go over. First, everyone is muted to limit disruptions. If you have questions, you're welcome to share them with us using that questions feature in your GoToWebinar control panel. If we have time throughout the presentation or at the end, we'll discuss some of your questions together, but if not, our team will follow up with you after the webinar. Today's webinar is being recorded and you can expect a copy of it in your inbox within 24 hours. When you leave the webinar today, you'll be prompted to complete a short survey. Please take a moment to share your feedback with us. We'd love to know what you thought about our webinar and other topics related to selling your business and other things we can cover. Joining us today, we have Saltmarsh shareholder Michael Cole and senior accountant David Garzon. We're also joined by our friends from Wells Fargo, Michael Callahan and Andrew Cardone. David, I'm going to hand it off to you to start introductions.
Thank you, Nancy. Good morning, everybody. My name is David. I'm a senior tax accountant here at Saltmarsh. I sit in Tampa, Florida. Mike and I work closely on business entities, so complex partnership allocations, C Corps, S Corps, a lot of federal and tax compliance. And that's a little bit about me.
Good morning, everyone. I'm Michael Callahan with Wells Fargo Advisors. Andrew Cardone and I work together in New York with in the institutional area, working on a number of different transactions for public and private companies through the years, and we're excited to be here to talk about the process and ways we can help.
Good morning, I'm Andrew Cardone, Wells Fargo Advisors. As Michael said, we have a tremendous amount of institutional experience coming from New York. I've been in the wealth management business now for a little over 12 years with a singular focus on working with private business owners to handle a lot of the complex needs that are required in a transition from ownership of a business into a retirement or a subsequent plan. And we're here today to talk about some of our experiences there and how we can be helpful to you and your families.
And my name is Mike Cole. I'm a shareholder here at Saltmarsh. I came from Saltmarsh from several different industry and professional accounting firms where I've been in national tax and mergers and acquisitions for RSM, Grant Thornton, and Ernst & Young, as well as acted as an outsourced CFO of a subsidiary of Gucci in Silicon Valley. So as we sit down and we think about it, and Nancy, if you could please move us to the first slide. One of the things that oftentimes happens is that we all get kind of consumed with running our business in the day-to-day life, right? We're all a part of a cycle that we've worked so hard to create a business that we always expect to go on either to our children or to other workers within our organization. But as you kind of approach the age of retirement, or maybe you've had a life event, a sickness or other event that limits your ability to kind of continue on, you always end up in a situation where you come to a crossroads where you need to think about, am I going to sell my business? To whom am I going to sell my business? And what does that transition look like? And so as we sit down and we think about this, there are kind of a few key and important questions that you should always be asking yourself and the people around you. Oftentimes, whenever we have a first meeting with a client that's contemplating selling, the first conversation is actually not about the financials. It's actually about the people and the heartbeats around them. What does your spouse think about you selling your business? What do you think your life is going to be like when you're selling your business? Why are you choosing to sell your business now rather than at some other time? And really coming to understand what are the levers or the mechanisms that both are causing the sale, and what might be implications or items that we need to identify as a part of the sales process that a buyer might want to be made aware of, or that might be linchpins in completing a successful transaction. So to that end, one of the items that we always ask is, how much longer do you want to work? People are almost always surprised to hear that when you own a business with less than $100 million of revenue, you're basically expected to work for a minimum of 2 years after the completion of the sale. Very rarely do you get to just sell your business and walk away. Recently, David and I have experienced transactions, especially in the medical practice, where they're asking key employees and doctors to stay on not for 2 or 3 years, but for 5 years after the deal in order to obtain the maximum amount of equity available. So when you think about, should I be selling my business now? Can I wait a few years? If you're saying, hey, I want to be done working in the next 2 to 3 years, but you're in the medical practice, you might be looking at a 5-year hold, even if you sold your business today. And so these are all really important items and conversations that could have an impact on a sales price that a buyer might want to know about, right? When we have a conversation with the attorneys and the financial advisors that are involved in this, and you say, hey, I only want to work for 2 more years, that might both limit the maximum amount that somebody might be willing to pay for your business, as well as, as Michael and Andrew know, it might also impact how they need to do their financial plan to make sure that you're going to be set up in a secure position to have the cash flows to continue on. Another item that oftentimes comes up is that my brother works for me, my cousin works for me, my best friend from high school works with me. What's going to happen to them when I sell? And this typically goes in one of 2 ways in a negotiation. Sometimes, there's a required retention for a few year period of time of certain personnel. And in other times, it's a severance package because maybe those people are not performing the job titles that they've been assigned with that compensation. And so we also have to have that honest and inward conversation with ourselves about the people around us and our key influences about how we work and about the people that work with us. And the last one from this slide that I just want to talk about this is really relates to legacy and community. And that's most of business owners in America are really focused in not just about bettering themselves, but bettering the lives of their workers, bettering the lives of the community that they're a part of. Oftentimes they have substantial charity investments, or they work with the towns substantially to make sure that they employ a large percentage of employees in that area and that everybody's in good standing. And so as a part of the transition, it's also important to remember that how you transition could impact your legacy within your community, as well as how it is that the clients that you work with, whether it be a buyer from a wholesale manufacturing and distribution company, or as a real estate professional, your tenants, how they're going to think, understanding and maintaining those relationships and effectively transitioning them can have a very substantial impact. And I know that Andrew and Michael can talk a lot about things like charitable remainder trusts and other items that are typically a part of a transaction plan, not just to make sure that the company is taken care of, but also those other outside stakeholders can be taken care of as well. Can you transition to the next slide, please, Nancy? So when do I need my accountant? The answer is going to be kind of always. As soon as you're considering selling, the accountants typically get involved pretty early to do what's referred to as cleaning up your books. And as a part of that, we want to make sure that we get all the financial information set up, all the kind of what's referred to as KPIs, key performance indicators, that private equity and other organizations might be looking for, as well as looking to maximize or adjust EBITDA and other cash flow analysis that oftentimes if you're selling to a private equity and not a strategic buyer, they're going to look for. They're going to say, hey, do you have excess spending here? Can we cut that out now? So that when you sell, you typically get a multiple of EBITDA. So if you can cut $100,000 of expenses and you get a 5 times EBITDA, well, that's an extra $500,000 in your pocket because you're able to cut an expense that you're getting a multiple on. At the same time, you can also sometimes forward income that you might not otherwise have recognized using different methods of accounting. So that way you're getting paid for money that hasn't actually been fully earned yet. And so really understanding how those cash flows and EBITDA calculations work can have a very big and dynamic impact on the way that your finances and your payout could occur.
That's right. And part of what Mike is talking about and how a CPA firm provides this is audits or reviews. This gives the buyers a higher level of assurance by saying, yeah, we've audited these financial statements, they look good, they're correct. It's similar to quality of earnings, but it also gives additional benefits. So not only does it give the higher assurance, which could lead to higher payout because the buyer's trusting more of the relationship, but also it's an opportunity to highlight key performance indicators. And we can see this as an SaaS or SaaS industry where we can see their retained customer list, or if you're in real estate, your occupancy rate.
Yeah, David, that's it exactly. Those audits and reviews oftentimes really change the dynamic and the focus in a negotiation or during a QOE study, a quality of earnings study that's being performed by a buyer, and can really change and adjust the way that they deal with you, because they know that the information that they're getting is going to be the information that they're buying. It also makes your reps and warranties in the negotiation a lot simpler, which saves everybody money at the table, because now you're not paying for lawyers to go through and doctor up one-off exceptions to accounting methods. Another item to really remember is that as a business owner, oftentimes the total amount of money you're getting paid isn't as important as the total amount of money that ends up in your bank account. And that's typically where tax structuring, tax equity savings, pre-planning for the sale, things of that nature can have a very substantial impact. I'll give you an example. We were working with a doctor practice where they had two offers on the table. The one offer was for a higher amount of money, but the way that they were going to do the allocation of proceeds would actually cause the effective tax rate on the transaction to be about 32%. The other company was offering about $1 million less of money, but all the taxes were going to be taxed at about 20%. The total savings on that was about $1.5 million. So even though there was less money as a part of the lower deal, there was more money that was going to end up in the pockets of the owner at the end of the day after paying Uncle Sam. And that can have, a really substantial impact on the way that we operate and the way that, financial advisors are able to manage your funds on an effective manner, which leads us to the last part, which is you've now made all this money. You need folks like Andrew and Michael to help you out in understanding where that money needs to go, how your budgets are going to work, and then your accountants are going to be needed to make sure that the tax implications and the cash flow implications that you're budgeting as a part of your financial and wealth management plan end up actually hitting your tax return, right? And so that's how teams really work well together. Are you able to hit next slide, please? So when you're selling your business, there's kind of a few key and important things. The first part is how are you going to structure your sale? You'll oftentimes hear it as an asset sale, an equity sale treated as an asset sale. These are all terms of art. For the most part, it's not going to make a difference other than the title that goes at the top of the documents that the lawyers are putting together. What's really important is purchase price allocation, and that's to what assets you're going to be selling or deemed to have sold. What the indemnity obligations are. So I'll give you an example of this. Let's say that you're entering into a transaction, but you're indemnifying that all the accounts receivable are going to be paid within 90 days. Well, if they aren't paid within 90 days, that could come out of your pocket. You might have to take money out of your pocket to pay the variance in accounts receivable. This is often done through what's referred to as working capital adjustment, but these indemnities and obligations and how your debts transfer or how your receivables transfer really impact the cash that goes into your account. Understanding what an escrow is. An escrow or a holdback is a part of the deal price that is subject to a condition subsequent. That means that in the event that you sell your business and it says, hey, we're going to pay you another $1 million if your revenue is $5 million next year. Well, you only pick up the income if you hit $5 million of revenue. At the same time, you only get the cash if you get $5 million in revenue, right? So these can be very important as well as substantials. As we hear a lot of economists talking about entering into a recessionary period, and as we look at rising interest rates from the Fed, earnouts, escrows, and holdbacks are becoming very, very substantial items in any negotiation. Right now, we're still seeing very high purchase prices with good multiples on EBITDA, but what we're also seeing is a real reduction in the amount of cash that people are getting up front, with a larger amount of these holdovers with holdbacks and earnouts. Lastly is rollover equity. A lot of people are like, oh, I've sold my business and I'm done. However, if you sell to private equity or a strategic buyer, chances are they're going to ask you to keep some skin in the game, at least for the duration of your retained working period, right? So there might be what's referred to as a put option or a push option, where after your 3 years of working, you can demand that they pay you out for the value of your shares. But for the most part, they're going to ask you to keep a little bit of skin in the game for at least a few years after the transaction. Very rarely do we see a deal without rollover equity. The most often times that you would see no rollover equity is when you're selling to what's referred to as a strategic buyer. This goes back to kind of the first slide when we were talking about why is it that you're selling your business? When do you plan to get out of your business? What are you looking for as a part of this exit? Oftentimes that would then mandate kind of or dictate the type of buyer that you could be interested in. So if you really want a clean exit, you want to be done, oftentimes that means you're selling to a strategic because they want to acquire your whole company and they have no second exit plan. However, if you're trying to maximize your cash flow and maximize the value of your business, you might be looking at selling to a private equity where they're going to ask you to keep some rollover until that private equity eventually exits from the transaction. And they'll call that a second sale. Oftentimes they'll talk this up as though it's a great idea. At the same time, it's really a very large cash savings for them because they don't have to pay you for the part of the company that you haven't sold. And lastly, we always want to keep deals simple. Some of these deals get so crazy. We had an $11 million deal for a small construction company that mostly did windows, doors, and other things. And the deal got so complicated because the buyer just kept on adding in caveats after caveats after caveats that eventually the seller said, hey, listen, hold up. We just need to stop and take a breath and say, what's the simplest deal that we can get to? Because when you have, tens of thousands of dollars in legal fees on a deal that small, the complications and the likelihood of there being a problem down the line just seems to rise exponentially. Next slide, please. Yeah.
So
you want to talk about good business hygiene?
Yeah, definitely. So good business hygiene is important at really any stage of business, whether you're looking to sell in the next year or you're first starting out your business and you're looking to sell right down in your career. We've seen in businesses who go to sell, they don't have good business hygiene, they have messy books, and they either pay for that cost at the end. They could have been keeping up with those books throughout the years, and so they pay the cost at the end, or their sales price decreases because, again, it's very important for buyers to have a high level of confidence in the product and business that they're buying. So we're going to highlight a few areas that we think are important in maintaining good business hygiene throughout your whole the entire life of your business. One big part is obviously tax and financial compliance. Understanding the state tax filing requirements in each state that you're doing business in. We refer to this as a nexus study. So a CPA firm would look at your payroll, your sales, your property in each state, and compare those to state law and advise you on your level of exposure. Buyers will also want to know this level of exposure because the last thing they want to do is buy a business and then all of a sudden they have liabilities in all these states that they had no idea about. So they'll want to see this before signing the business or finalizing the deal. We've seen for manufacturing industry how you're selling inventory throughout the whole country, or specifically you're selling, say, on Amazon, and something that Amazon does to get that inventory to customers quickly is they have it in warehouses all over the country, and so you might not even know that your product is in close to all 50 states, and that can open up a can of worms if you're not proactive in looking at your state filing requirements. Another big part is understanding asset and debt management. So looking at your accounts receivable, accounts payable, it's important in knowing what your working capital requirements are, what your current working capital is, what your future working capital is, and a buyer will want to see how much cash is required to run this business, but also it's important in knowing how to forecast and knowing that it has the ability to forecast because you have clean records of accounts payable and accounts receivable. And the last one,
David,
go ahead.
Can I just kick in on that real quick? That's really super important, especially in wholesale manufacturing and distributions, where so oftentimes you've got a distributor that is buying from your manufacturer, and you might have 30-day payment terms, 90-day payment terms, 60-day payment terms, or maybe you're using an intermediary financing loan obligator to kind of finance your accounts receivable. That type of documentation and understanding as to how your business operates compared to the norms. If you're able to say, hey, we've got a great relationship with our distributors, and we've got typically 30-day terms, and the rest of the industry is on 60 or 90-day terms. Well, that's a real add to the value of your company, that you might be able to get another quarter turn on EBITDA, because you can show that your cash flows are really well managed and your contracts are really well done. At the same time, let's say you've got a whole bunch of shareholder loans or partner loans or loans to employees that haven't really been documented and no one's really been keeping track of. Those types of things tend to be a real detractor from a buyer, because they're like, well, what isn't documented, right? Or why is this not maintained and being accurately followed? What else isn't being maintained and accurately followed? And so they can just kind of be little red flags, if you will, when you're having those conversations with a buyer that you really want to have cleaned up and well maintained. Sorry, David, didn't mean to jump in on you there.
No, you're good. Another important part to maintain is your capital accounts. One way that we are able to plan out your tax impact and just recommend strategies on tax savings is by looking at your capital accounts and seeing where they could be allocated. And also the last thing you want to do is pay more in tax because your accounting for your capital accounts was incorrect the whole time. Another important part is business line accounting, so that you could see the profitability of each component of your business. Say your business grows and you don't want to sell the part that you really enjoy working in, but you want to sell this other part of your business. Well, your buyer is going to want to know the profitability of that segment. So it's important to keep track of your different business lines and have proper profitability records in those pieces.
Yeah, that's great, David. Thank you. And again, you know, this is really important, especially in construction, where oftentimes you might see a, let's say you're doing land improvements or site work as a part of one division, and you're getting ready to, you want to sell that division, but maybe you want to keep your heavy construction or, you know, especially here in Florida, say a water repair or water maintenance kind of project as separate. If you don't have good line accounting, it becomes almost impossible to spin off those divisions as you look to either simplify or diversify your investment strategy. And now I think it's really great to turn it over to Michael and Andrew, and they're going to talk about this transaction kind of from the way that they see it. And what I love about them is that they're going to talk to you about not just the transaction and kind of how it happens as an event, but they're also going to talk to you about how it's kind of a part of a whole process and a part of a lifestyle adjustment. So Andrew, Michael.
Thanks, Michael. And I want to, again, take the time to thank everyone for joining here. If you're here, there's a very good chance that you've created, you know, a business with complex financial needs, and that you're certainly considering the possibility of the business, you know, changing hands and creating a complex liquidity event. And, you know, one of the things, you know, that we emphasize here is planning. You know, studies have shown that, you know, most business owners that have sold and had, you know, financial problems as a result, they cite the failure to plan well in advance of a transaction as the reason that they've struggled. And so before you're actively pursuing a sale or a transition, there are a lot of planning techniques that can lay the groundwork for it to be successful. And critically, you know, you want to have the right team of advisors on board with you advocating for your success. And that's why we're pleased to be here with folks like Michael and David, who we think are, you know, critical subject matter experts in operational finance and tax. And so this slide, you know, the important thing to emphasize here, we think of this as a parallel path. So, you know, there's the business side of the transaction and the personal side of the transaction. And we sort of intersect with the two. You know, we've been through a number of private transactions, companies that have sold to strategic competitors, also to financial sponsors. The nuances of those transactions can be a little bit different, as Michael was describing, but the emphasis on the process, you know, is very similar. And where we intersect is, you know, we work hand in glove with folks like Michael and David, you know, at the beginning stages where operational finance is being enhanced, also at the beginning stages with a competent, you know, trust and estate planner. because getting all these things right and aligned is ultimately going to lead to an optimized outcome for you and your family. So, again, to reiterate some of the things that Michael was talking about here, on the business side, early in the process, and typically a transaction once you go to market can take, 9 months to 12 months. Prior to that, also, you want to have completed a lot of your, estate tax planning needs. By the time you get a term sheet or an LOI, the IRS is going to look very differently at the value of your company. And we'll talk a little bit about that later in the presentation. So, you can do certainly a number of things within the enterprise to enhance value. Michael talked about strategic income tax planning, looking at organizational structure, and deal structure to maximize the proceeds. On the personal side, we advocate really early on, doing an estate plan review, looking at wealth transfer planning, looking at your pre and post transaction cash flow and insurance needs. Are you philanthropically inclined? There are things specific to those needs that need to be addressed. And really, one of the most important things away from the business transaction and even the estate planning and the techniques involved there is, discussing your transition expectations with your family and reviewing some of the obstacles that you might face around the emotional side of a transition. Michael said, you've built a business and it's been your baby and you've had control over this, handing it over to someone else and often being asked to have a new boss for 2 years, is a big psychological transition. So it's important to, work through that process and really spend the time, with you and your family, understanding what that's going to look like to help prepare you for that. So, we're certified exit planners. This is what we do. It's the sole focus of our practice. We will help introduce you and work with, the subject matter experts like Michael and David, as well as, specific investment bankers in your industry. And we'll talk to why that's important a little bit later, as well as some of the leading national estate tax planners. So we can come back to this slide, but just wanted to make that quick introduction there, and we can go to the next one. Michael, you can talk about laying the groundwork.
Yeah, thank you. Good morning, everyone. I think that the main part, along with the process, is that Andrew and I are focused on your family and making sure we achieve what you and your family want to achieve. And your family is going to extend down into employees. Some of these people, Michael was saying, could be cousins or brother-in-laws or things of that nature. But we understand that your implied, need to make sure they come out of this hole, they feel comfortable. So we're cognizant of a lot of different behind the scenes events that are going to take place. We also, again, are going to focus on making sure that the intersection of all of the subject matter experts, from the attorney perspective, you've got corporate attorneys. Prior to the event taking place, you've got trust and estate attorneys you're working with. You've got the accounting firm that these guys have discussed some of the process and procedures they're going to want you to affect in order to maximize value for your business. And then last and most importantly, from Andrew and my perspective in an area, is the investment banking component that comes into the process and why that's needed, how we can help you vet them, how we can help you prioritize them, which ones have certain niches and certain verticals they do well in versus others, what you're looking, and then it becomes a comfort level. And we're going to try to discern all that and make sure that we're matching the right people with the right bankers and got the documents moving down the field on both sides of the parallel path from the prior chart that Andrew was talking to. If you'll go to the next slide, please. So again, here are various structures. The most important one are usually the strategic sale, the cross purchase or ESOP are less prevalent at some level, and so it's a strategic partner, and it's also understanding that you may have a business where you're not aware of private equity's activity in that space to the degree you may be. You may not be aware of international companies looking to get a foothold in a distribution capability or a manufacturing capability in the vertical that you currently occupy. So there are a lot of different reasons that we would interface with the banking after, we've helped you decide on which way to go, but making sure that their outreach is encompassing every potential buyer that is out there in order to maximize your options, whether it's the highest price or the best tax efficient return of capital. The other thing Andrew and I focus diligently on is when we're setting up structures for you post sale is making sure it's a tax efficient product you're going to be in, which will enable you to maximize your legacy, what you're leaving to your heirs and things of that nature. So there are different strategies we'll invoke, 1031 exchange funds we have internally, different tax harvesting products we have internally. So any myriad of products that we can bring to the table that's going to customize and fit your business and your specific needs post sale going forward. So we can go right to the next slide, please.
So sometimes a lot of this can sound like a bit of complexity. So wanted to talk perhaps to some tangible examples of what all this can mean. So one situation I was involved with was a regional airline business, and there were 3 owners, and their exit plan initially was to sell the planes and the hangars and the real estate and divide the proceeds among the owners. And they had talked to a generic business broker who came up with a value of the company's assets, around $60 million. And I advised the owner of the business to speak with, an aerospace investment banker. And he said, "What's that?" And I said, "Well, somebody that sold a business like yours in the last year is going to know the roster of buyers that were out there, the prices that were paid, and can kind of think about, your company a little bit differently to enhance the value of a brand or a particular geography that you're operating in. What are the challenges for competitors to get into that? What moats around, that business exist?" And anyway, at the end of the day, that business, instead of for $60 million, was sold for $180 million. Quite a difference for the 3 partners. As part of the process, this was a family that had 21 grandchildren, 7 children, complex family, dynamic. And so we were able to set up, 2 dynasty trusts, by the parents, which took out about $25 million from their taxable estate. So those trusts now exist, for the benefit of their children and grandchildren. And the family was, certainly very happy with the outcome there. The important thing is, we were involved in helping them set up their estate plan, 6 months ahead of when the transaction was closed. And the reason that's important is that as a privately held business, you have non-marketable shares. You can often apply, and we can talk about this at our event, you can apply a discount to that business when you're making gifts into the trust. And so the appreciation that happens once the sale is consummated occurs outside of your taxable estate. And there's some changes to the tax laws that are coming up at the end of 2025, which we think are important to get ahead of if you're considering a transition. We can take Q&A on this later, but if we go to the next slide. This was a little bit different. Met the founder of a health and life science company earlier on, and they weren't necessarily thinking about selling. They were doing about $5 million in revenues. They knew that they wanted to sell the business, but they also knew after having some conversations with them, we identified some customer concentration issues. Roughly 50% of their business was from one customer. They were also undercapitalized relative to their peers, and that's something that we can do for CFOs, is do an analysis versus your peers as to kind of what your balance sheet looks like. And we recommended at the time, debt was very low cost, so we were able to provide debt to the business as working capital and help them expand their international operations, help them diversify their concentration issues. In the process, They were also able to beef up their management team. So again, in the process, knowing that there, was a potential exit, in the future, we were able at the time to set up 2 spousal access trusts and a charitable foundation. So when the business began to ramp, they went from about $5 million to $30 million in revenues in about an 18 to 24 month period. We went through a process of introducing them to 3 specialized investment bankers in the health and life science space, and it resulted in a sale to a publicly traded company with over $100 million, in profit to the or realization to the owners. So we were able to get, as a result of the trust, which we gifted at a very low valuation, roughly $50 million was removed from their taxable estate. So they were able to allocate a significant portion towards their philanthropic goals. They've got essentially a perpetual dynasty trust, where that $50 million will appreciate outside of their taxable estate. And then once the transaction was consummated, we helped them invest in an opportunity zone fund, which led to roughly $1 million in tax deferral savings. So, again, emphasizing the importance of getting ahead of the transaction, having an exhaustive planning process with advocates like, Mike, Dave, trust and estate attorneys, investment bankers. Typically, owners will go through this process, one time. And so it's important to get it right. And, getting it wrong can lead to, missed opportunities. And I'll cite 2 reasons, while we're here, since there's no investment banker on the phone. But the reason that we advocate, that business owners work with investment bankers is, one, you want to get to a close. So, owners that try to do this on a DIY basis often fail to get across the goal line. The last thing that you want to do is show your potential buyer, your customers, your key managers, your key employees, you've lifted the kimono in a due diligence process, and at the end of the day, they say, well, we're going to offer you 30% less than the LOI. Now, there's not necessarily a plan B or C in place, and that you wasted almost a year going through that process. So we do think, it's important to, get into a planning process, get the right advisors who have been through the process to optimize your outcome. The second thing is studies show, and we can provide them, that in a represented transaction, you're typically going to see a 20 to 30% appreciation over the value, of the business. And that's because, the bankers are going to run a process, and they've got a universe of potential buyers, either financial sponsors or strategics, that you don't know. And so like Michael was saying, there may be a foreign buyer that needs access, to a particular geography. There might be a family office. I mean, family offices globally have exploded over the last 10 years just because of all the wealth creation. And those are unique buyers that may, be more like a private equity buyer as a financial sponsor, but not necessarily as motivated to have to sell your business again within 5 years. So these are the nuances, that we can certainly, consult with you and discuss and help educate you around. I'll turn it over back to you, Mike.
Thanks, Andrew. And that's really an excellent point. And one of the things I love about the last slide that you just gave is that not only does the trust and estate planning happen early as a part of the business operations and functionality, you really showed how you were caring about the heartbeats. It was shown about how, the trust and estate plan, the exit wasn't just about the people that were owning and operating the business. It was about their spouses. It was understanding the trust that needed to be involved to handle children and other things in the first slide. And it really goes to that oftentimes in these M&A transactions, it's not just about the person who's running the business, it's about everybody else who's around them. And, a large portion of our planning and our opportunities and our thought processes and how we approach things is really about following that heartbeat, understanding what's going to keep somebody up at night, understanding who we need to take care of and who needs to be kind of a part of the decision-making process, not just from a financial standpoint, but also from, a legacy or a stability standpoint, to allow business owners to, sleep well at night, knowing that they've taken care of their loved ones, or that, the businesses that they've built up in a community is going to stay there for a longer period of time. These can all be very influential factors, kind of as we deal with not just the financial side, but also the emotional side of a transaction. So to that end, I want to talk about a very closely held roofing and water company that was owned by a very small number of shareholders in an S corporation. When they went to sell, they were really kind of contemplating how it was that they were going to be able to, one, continue the legacy in Florida that they had actually created. They wanted to be able to invest in new opportunities and kind of diversify their portfolio, but they also wanted to be able to make sure that their children and their spouse were taken care of as a part of the transaction. And to that end, utilizing similar structures to what Andrew and Michael have already chatted about, we utilized a charitable trust, which transferred part of the value into the trust, similar to the way that Michael was talking about how they used the spousal trust early. We transitioned value over to a charitable trust that had a lower value because it was prior to the sale. It was a year out. So now the valuation from the IRS's standpoint can be lower. There's enough time in between that kind of creation prior to sale to allow for that value to appreciate into what we were expecting. We utilized an opportunity zone, which is a type of fund that you can invest in real estate and other businesses in order to defer taxes until 2026. So your first tax payment actually isn't until 2027. And then let's say you invest in real estate, your eventual exit from that real estate is actually tax-free as well. So not only do you get a deferral, but you also get a tax-free exit from your next investment. And lastly was because they really want to be a part of not just continuing the work that they had done to build the community around their business. They wanted to make sure that they were providing back to the community. They actually negotiated with the city additional benefits for the real estate and the buildings that they were placing in service to lower their overall tax burden, to make sure that it was going into a neighborhood that might not have otherwise been invested in. And both the city and the business found great value in working together to make a great joint venture, if you will, between lowering their tax burden to allow for greater investment and to give people a place to work in the future. Negotiated local or state benefits oftentimes get a bad rap because sometimes the ones that make the news are the terrible ones that you hear about, like Foxconn in Wisconsin, where they promised $1 billion in investment and they hired 13 people and took massive tax deductions, right? What they don't tell you about is that these types of negotiated benefits happen every day all over the country, and they really can create some great unique partnerships between businesses and governments to allow both the business to flourish as well as those individuals a part of the community to have an opportunity that they might not otherwise be able to do because of financial limitations from a high tax base. And so for us, when we look at this case study, what we love to talk about is the fact that we deferred taxes. We were able to generate a tax-free exit from their eventual investment in real estate, which is a plan that they were wanting to do. And lastly, we were able to increase their cash kind of flexibility in their new investment by providing property tax mitigation. And Andrew and I were actually chatting just a few minutes before this about how opportunity zones have really become a very potent and powerful part of the tax planning and exit structure, but it takes a real team to be able to make that work. And so from my end, it's, understanding how to structure that fund, helping the client to do the cash flow projections as to what they need to do in order to be able to improve and maintain the property, what their exit's going to look like, what their cash flow is going to need. And Andrew, maybe do you want to talk about kind of how you guys see and understand that cash flow management during construction and how it's a part of an overall fund life and things of that nature? It was really great hearing you speak earlier.
Well, so in the example that we provided, a lot of times you can do an individual opportunity zone fund, but there's a lot of strict rules around when you have to identify the property, where the money goes to before it's invested in the property. So it's absolutely critical that when we're having this discussion, we're hand in glove with Mike, because a mistake that's committed in that can really deleteriously affect your tax treatment, which would sort of negate the whole purpose of it. But we've historically utilized funds, opportunity zone funds, for that manager, for that reason. So we'll pick an operator like I'm just making this up for right now, but like a Brookfield, for example, which is a well-known global diversified property manager, and they will carve out investments that they've made in their portfolio and identify them as opportunity zone properties. So, a lot of the Identification of the properties are handled, by, the Brookfield. A lot of the tax measures, though, are still, going to be needed to be, stamped with Mike's approval, in terms of where that money's coming from and where it's going to, and is the tax treatment aligned with, the particular, tax jurisdictions that you might be aligned with, state-wise or federally. Does that make sense, Mike?
Yeah, absolutely. And another thing that I think both you and I kind of chatted about as part of our case studies are charitable trusts. And, one great tax planning opportunity is a charitable trust with a life insurance policy, and how those can kind of can work together. Do you guys have any experience working with those?
Well, we do. So, it's a really elegant planning structure if you're charitably inclined. The beauty about the charitable trust is you can identify the beneficiary of that trust. Let's just say it's your alma mater. So you create the charitable trust and fund it, and the distributions that come out of that trust for the 20-year life of the trust can be utilized to pay. We use second to die life insurance because typically, business owners that we're seeing, that are monetizing a business, tend to be in their 50s, early 60s. The premiums on second to die life insurance, with a 30-year life associated with them, typically the second spouse, the woman's going to live, roughly to around 90 is the actuarials. So you can get, pretty good premiums and pretty good leverage in a second to die life insurance policy, and that can accrue to the benefit of your family or be used as an elegant estate planning technique.
Yeah, that's great. And we use that charitable remainder trust as well as tag teaming with solar farms. So sometimes, maybe an opportunity zone isn't a great idea, or maybe they don't necessarily want to go into a charitable trust, but we'll utilize a wind, a solar, a hydro farm, that's going to generate a substantial tax credit. Sometimes this is used through historic rehab credits for construction folks to mirror on the cash flows from out of that investment methodology to lower the overall tax burden by generating tax credits and depreciation and other things, as well as taking that cash flow to do the same thing and buy life insurance policies that will eventually kind of generate a larger tax deferred exit that also are included as part of somebody's estate. So not only are we lowering their tax burdens today, we're giving them an investment and cash flow opportunity that takes money out of their estate. So, there's lots of different ways to kind of structure these different opportunities to really facilitate the needs of each individual client. And I think to Andrew and Michael's point, when they were talking about that 3-year prior, when people need to start getting involved, that's the reason why understanding your intent to sell, be it 6 months before or 3 years before, the earlier that people like Andrew and Michael or myself get involved, the easier it becomes for us to create a plan that not just gets you a good outcome, but gets you a great outcome to meet not just the financial needs, but also kind of the other needs for your life after your business. And so, the more that we work together, the more that we talk, the easier it becomes to facilitate goals. And so I think the next slide is questions, if I'm not mistaken, isn't it? Oh, sorry. Go ahead. Michael or Andrew, do you want to talk about the Business Owner Summit that you're hosting coming up?
Yeah, in June, Andrew and I, with our friends here, and we've got legal from Holland and Knight. We've got a merger and advisory firm that's going to present. We're going to go really kind of take it down to the next level at this June 8th event at the University Club. It's 12 to 2. It's 3 or 4 speakers followed by a panel. That panel will include some business people that have effectively sold, and they can comment about the pros, the cons, things that went right, things that came out of left field that they had not anticipated, and things of that nature. And then following that, either before or after, if you want to come in and speak in a little more private setting, Saltmarsh's office is a couple floors below the University Club. So we're going to host one-on-one meetings for yourself or your management team or whomever you want to bring along to discuss, what you're considering and trying to set the structure up early on to have an effective and successfully accomplished transaction.
Yeah, Michael, thank you for that. And I think as you talk about, so many other people that are going to be a part of this wonderful event, it's really also too important to remember that sometimes the person that's been your lifelong accountant is a great sounding board, or your lifelong attorney is a great person to have as a part of the communication and conversations, but that might not be the right person to handle a complex negotiation for the sale of your business, just because they can handle, your jobs. If you're a construction company, understanding, the rights and obligations in a job schedule and how that's going to impact, the offers you make as you kind of go to market in an RFP. And so it's really kind of important to remember that building that team out, as you guys are clearly identifying, can really bring in some unique perspectives and some different ideas. So Nancy, I see you've joined us again.
Yeah. So we didn't have any questions submitted, but I'm sure we'll get some in our follow-up survey. But I just wanted to thank you guys for joining us today. And I know our audience learned some high-level information on how to sell their business. Again, audience, if you're interested and you're in the Tampa area, we would love for you to join us for this June 8th Business Owners Summit. Lunch will be provided, so you can RSVP to that by emailing Andrew, and his email's right here on the screen. But as I mentioned before, today's webinar is being recorded, and so you'll receive a copy of it along with a slide deck in your email very soon. Be sure to check your spam and junk folders in case it lands there. But thank you all for joining us, and we all hope you have a great rest of your day. Bye, everyone.
Thank you.
Thanks.
Thanks for joining.